Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals, in our 26th year in business. It's Sunday afternoon, February 22nd, 2015, and the title of today's audio blog is What's More Fraudulent, Mining Resources or the Greek Debt Deal? Fraud everywhere, as far as the eye can see. From politics to economics to financial markets, not a shred of truth remains in a world engrossed in the terminal stage of fiat cancer. Consequently, the worst aspects of human nature are front and center on a daily basis, as the handful of global leaders pull out all the legal, ethical, and moral stops in their goal of maintaining a status quo that keeps them in power and enables them to retain nearly all the world's wealth. It's no coincidence I'm reading Mein Kampf. Not that I fear a racial holocaust, but a global war on truth that will rival history's most virulent propaganda campaigns. Fortunately, the truth always wins, by hook or crook, and in this case will do so spectacularly. In much of the world, it already has, as evidenced by plunging currencies, commodities, bond yields, employment, and GDP. And ultimately, quote, last to go markets like the Dow Jones Propaganda Average, paper gold and silver, and the reserve currency itself will succumb too, as the unstoppable tsunami of reality overcomes their best efforts to avoid it by printing money, manipulating markets, and lying about everything from economic data to bailout agreements, policy statement minutes, and ceasefires. Anyhow, the worse the terminally ill global economy gets, the more pervasive the lies describing it will become. On any given day, the breadth and intensity of horrible headlines appears to expand, as Friday alone, when the North American rig count again plummeted, the Baltic Dry Index again closed at an all-time low, as Chinese inbound cargo traffic plunged. The U.S. manufacturing PMI depicted not only declining employment, but also the lowest new orders component in a year. A Japanese PMI reading barely was in positive territory, and global construction equipment bellwether John Deere forecast a 17% plunge in fiscal 2015 revenues. And this just 2 days after the Fed implicitly admitted its January 28th policy statement was an unabashed lie, when the minutes of said meeting depicted the majority of participants fearful of a weakening economy, and thus no longer even considering 2015 rate hikes. Which, of course, is what I have claimed all along. As discussed in Thursday's audio blog, the Fed flat out lied, and the whole world knows it. In fact, Whirlybird Janet directly contradicted her ridiculous comment of less than 2 months ago, when in the December 17th FOMC policy statement she claimed, the decline we've seen in oil prices is likely to be, on net, a positive. Well, fast forward to the January 28th policy statement, when she agreed with this by simply espousing about oil prices that recent declines in energy prices have boosted household purchasing power. And thus, it struck me as extremely fishy when the so-called minutes of that same January 28th meeting, which we just learned of on Wednesday, her new take on oil prices was 180 degrees different than what the bogus policy statement said, i.e., persistently low oil prices could dampen the overall expansion of economic activity. Which, by the way, jibes far more closely to what her counterpart at the Bank of Canada, Agatha Cote, said on Thursday, i.e., low oil prices are unequivocally negative. They have a broad impact on the economy, with the negative effects happening quickly. Which brings me back to a certain nameless website's prediction that gold prices will be pressured by Whirlybird Janet's Humphrey Hawkins testimony this coming Tuesday, just 6 days after the release of said minutes. In other words, does anyone really believe she'll change her tune again, particularly if the PPT is able to continue goosing the Dow Jones propaganda average by saying all's well, as plunging oil prices are no doubt transitory? To that end, all I could say is thus. With the U.S. stock market, objectively, trading at its all-time highest PE multiple, yes, higher than either 2000 or 2007, an historically stark contrast between surging stock prices and rapidly plunging macroeconomic data, 90% of the world's industrialized economies having official interest rates at or near zero, and daily final currency war pronouncements, such as the Danish central bank Friday threatening currency controls in its desperate misguided goal of maintaining a Swiss franc-like peg to the euro. In other words, Whirlybird Janet better be careful what she says. To that end, I cannot emphasize enough that the Fed chairman has never discussed or even hinted at future policy changes in a Humphrey Hawkins session, and thus the odds of this implicit policy changing next week are slim to none. Which brings me to the primary focus of today's audio blog, i.e., the economic fraud that mining's resources have always been, and the political fraud that was Friday's Greek bailout deal. That is, if what was actually proposed is ratified before this Friday's final deadline. Can the question posed by today's title, i.e. which is more fraudulent, actually be answered? Likely not, as they are apples versus oranges topics. However, they are equally misleading, and in the end game, equally devastating to those trying to fool the masses with accounting chicanery and propaganda. To that end, let's start with a topic that just thinking about it makes me nauseous, which is the unmitigated misery that essentially all aspects of gold and silver mining have become. In gold's case, cartel suppression has destroyed the business permanently, at least in terms of its ability to profitably grow, or for that matter, to grow at all. To wit, yesterday's article, Initial Mining Earnings Essentially Confirm Peak Gold. As for silver, production is slightly less elastic than gold, as roughly 2/3 is byproduct from other mine types, principally lead, zinc, and copper. However, while cartel price suppression has a lesser impact on silver production, economic depression has a massive impact. That is, when base metal prices plunge, as they started to do earlier this year, and did so in dramatic fashion in 2008, byproduct silver production eventually plunges too, which is exactly what the participants in Miles Franklin's All-Star Silver webinar panel forewarned of in October. That said, what I am referring to here is not the macroeconomic issues impacting precious metal production, but the flimsy, arbitrary accounting assumptions underlying them. To that end, let's go back to the infamous Bre-X scandal of 1997, when a highly hyped Indonesian gold deposit, which caused Bre-X stock to surge from a penny stock in 1995 to $287 a share 2 years later. When one of the company's geologists was murdered by being thrown from a helicopter into the jungle, people started to suspect something was fishy about the gold deposit. And lo and behold, it turns out the rock samples had been salted with gold dust in an historic fraud that to this day hangs over the credibility of the entire junior mining sector, to the point that the Vancouver Stock Exchange name became so tainted it was changed to the TSX Venture Exchange. You know, like my former employee, Solomon Smith Barney, ditching its name because management believed the Solomon name was tainted, only to replace it with Citigroup, whose subsequent criminality put Solomon's to shame. Anyhow, in the aftermath of the Bre-X disaster, Canada instituted a dramatically more thorough, comprehensive regulatory framework for the accounting and reporting of mining reserves, featuring the now ubiquitous NI, or National Instrument 43-101 resource statement. Given the strict guidelines of such reports and minute details required to complete them, it was believed that industry credibility would be boosted as a result. However, such statements, just like the parallel JORC statements in Australia, are still written by mortal men and women, utilizing arbitrary, subjective assumptions with many of the same conflicts of interest. And nowhere is such randomness more obvious than the lesser resource categories, i.e. measured, indicated, and inferred, as opposed to the more vetted, proven and probable reserves. Not that reserves themselves are flaws, as trust me, from the 5 years I spent working for mining companies, visiting and reporting on metal deposits the world round, I saw many such sure things turn out to be complete and utter failures. And not always due to flaws in the NI 43-101 statements, which were many by the way, but rapidly changing political, economic, and financial conditions. To wit, I worked as head of investor relations from 2008 through 2010 for a company with what was believed to be one of the world's largest cobalt deposits, deep in the jungles of Cameroon, Africa. And I visited, believe me, it was deep in the jungles. Just before I joined the company, the junior mining sector, as measured by the TSX Venture Exchange, had hit its all-time high in spring 2007, and with cobalt at an all-time high of $50 per pound, the company was able to raise more than $100 million at its all-time high stock price. Shortly after, a massive cobalt reserve was reported under strict NI 43-101 standards, as measured by a highly reputable geologic consultant, followed by a diligently researched estimate that the mine and processing plant would cost just $129 million, again per NI 43-101 standards, calculated by a reputable engineering firm. However, less than a year later, an updated feasibility study raised the cost from $129 million to $398 million, and a year after that, an optimization study upped that figure to $617 million, whilst cobalt prices had fallen to nearly $10 a pound, yielding a dramatic double whammy to the project's net present value. Again, each study was conducted by a respected engineering firm via strict NI 43-101 standards. And by the way, from someone who witnessed the progress of the fatal optimization study from beginning to end, I can tell you that the amount of arbitrariness and negotiating that goes into final numbers would terrify any potential investor in the sector. And nowhere more so than the discount rate that's used to discount cash flows way in the future, which couldn't be more arbitrary. In other words, such complex projects are constantly in flux, with countless factors conspiring to relentlessly raise costs and reduce net present value. Frankly, the only time mining projects truly turn out to be big successes, by and large, are when the deposits are objectively the world's best, or alternatively, if commodity price surges subsequent to construction are able to mask the relentless cost increases and delays. To that end, I could write a book on the hurdles this particular ill-fated project experienced on its way to oblivion, despite many well-meaning, intelligent people using what were once deep-pocketed resources, putting every ounce of their beings into it. Why did I tell this story, you ask? To give insight into what even the world's largest, best-financed mining firms must deal with, particularly when dealing with gold and silver projects, which not only must deal with the aforementioned geologic, engineering, and cost issues, but a price-suppressing cartel, unethical banks that naked short shares to extort usurious warrant-based financing, and greedy governments that in the blink of an eye can decide that gold and silver resources are national security items to be nationalized or windfall taxed. Without a doubt, and this coming from someone who worked in the oil and gas industry for a decade, metals mining, and particularly gold and silver mining, is one of the world's most dangerous, risky businesses, and gold and silver mining stocks among the world's most dangerous, risky investments. And trust me, what the aforementioned cobalt company dealt with is nothing compared to what tiny, extremely undercapitalized gold and silver firms must deal with, which is probably why more than half, and more accurately, 3/4 or more of such firms have either gone bankrupt since the TSX venture peaked in 2007, or are effectively such, with barely enough cash to maintain an exchange listing and keep the doors open. This is why the San Francisco Mining Conference, by the way, was canceled in November, because literally no one had enough money to show up. Thus, the importance of Thursday's peak gold article, particularly in an environment of cartel-induced price weakness, unparalleled capital strangulation, and sundry exponentially increasing barriers to profitability. In that article, and countless others before it, I wrote of the coming PM mining Armageddon, such as my 2015 predictions audioblog, in which I forecast gold and silver mining industry paralysis. And after witnessing the first batch of mining industry reports, I am more confident than ever of such. That is, unless the cartel is decidedly broken in the coming months, causing gold and silver prices to race past $1,500 an ounce and $30 per ounce respectively, which would have no material impact on production, but likely would yield significant capital spending increases, in the hope of future production. In that article, I warned particularly of declines in the lesser resources category discussed above, i.e. measured, indicated, and particularly inferred, which frankly aren't even close to being considered economically viable. To wit, I noted how Kinross Gold this last week, that they wrote off 35% of their reserves in 2013 and another 20% in 2014, and this with no change in its $1,200 per ounce gold price assumption. Yes, I'm talking about supposedly ironclad reserves, not the aforementioned highly dicey resources, with no change in price assumption, like the 80% cobalt price plunge noted above. And then there's the case of Coeur d'Alene mining, which despite the utilization of way above average and above market price assumptions of $1,350 per ounce gold and $1,950 per ounce silver, wrote off a whopping 45% of its measured and indicated gold and silver resources and 36% of its inferred resources. Its CEO desperately tried to spin this catastrophe as a new quantity over quality strategy, but suffice to say, investors weren't convinced. Coeur, Kinross, and countless other majors are trading at or near all-time lows, including the big three gold miners Barrick, Newmont, and Anglo Gold. To wit, Barrick is down 76% from its 2011 high to a level last seen in 1993. Newmont is down 67% to a level last seen at the turn of the century, and before that, 1987. And Anglo Gold, which reports earnings Monday, is down 82% to the level it traded at when it went public in 1999. However, none of those disaster stories compared to that of Silver Standard, ticker SSRI, which on Thursday wrote off 91% of its proven and probable silver reserves and 97% based on dollar value due to its inability to acquire water rights from Mexico's Semarnat environmental agency. I don't follow this stock anymore, so it wasn't exactly new news when the official reserve statement was received on Thursday, which is probably why the stock was already down 90% from its 2007 high to a level last seen in 2003. However, in my mining stock heyday, I was well aware of its reputation for being the silver reserve development company, which is why it's not the fact that it had to write off such a huge amount of reserves that's the real story, but the fact that such reserves represented the seventh largest silver deposit in the world, twice as large as those of the world's largest silver producer, Fresnillo of Mexico. And no, they didn't write these reserves off entirely, but instead relegated them to the lesser resource categories. But given management's description of the water rights issue, and my previous dealings with miners attempting to extract permits from Semarnat, they could just as easily have written them off entirely, similar to what Barrick was forced to do last year with its hopeless Pascua Lama gold project straddling the border of Chile and Argentina. And thus, the moral of the story is that any and all mining resources are suspect, particularly in a weak price environment, and sadly, so are many, if not most, mining reserves. Well, I hope you enjoyed that tale of woe, which if you are a physical gold and silver investor hoping for diminished supply, you certainly did. However, with the exception of Bre-X and a handful of others, the word fraud is clearly not appropriate. Mining is simply a very, very difficult business, and thus it's not that gold and silver reserves and resources are fraudulent, but instead extremely suspect, which is far more than I can say about the supposed Greek bailout deal, which by the end of this week may not even turn out to be a deal at all. To that end, kudos to Michael Pento for putting his cojones on the line in boldly predicting the deal would fall apart, yielding rioting in Athens on Monday, i.e., as you are listening to this audio blog. As for said Greek deal, yet again conveniently announced just in time for a late Friday stock goosing by PPT algorithms, I'm not going to rehash the saga from its beginning. Instead, I want to point out that whatever it is that was supposedly agreed upon, 99% of the investment public has not a clue. And again, Greece still has to submit a broad list of proposed reforms on Monday, i.e., as you listen to this, which the so-called Troika, which has now ignominiously been renamed the institutions, still must approve before the current 280 billion euro bailout deal expires on Friday. And by not a clue, I mean the statement issued by the Eurogroup, which itself, even 99% of the investment community doesn't understand, even many Europeans, is pure unmitigated gibberish, which even Janet Yellen's Federal Open Market Committee would blanch at. And thus, in yet another crystal clear example of how dumbed down, propagandized investors, media, and politicians react not to substance, but manipulated financial markets, we have Friday's bullish reaction to news that Greece and said institutions agreed on something, let alone the fact that the Dow, S&P, and even the German DAX were already at record levels when the unexpected announcement occurred. Although if you didn't know better and simply read the drivel published by the brain-dead MSM, you'd think it was the most shocking announcement ever. To that end, the MSM Moron of the Year award, as Bill Murphy would call it, goes to perennial champion Yahoo Finance in claiming, quote, markets reacted positively to the deal, with the Dow and S&P 500 surging to fresh records as fears of a catastrophic exit by Greece from the euro receded. Yes, fears of a catastrophic exit receded, even though the Dow and DAX were already at record high levels when the news emerged, and gold already down $100 per ounce from the date of last month's Greek elections. Anyhow, I have all along, as in the past 4 years, claimed Greece must default on its debt if it wants to survive, as anything other than a third world banana republic. Not to mention the other pigs and countless other nations, including eventually the United States of money printing. This is why Syriza, a 4-year-old political party, stormed into power in Greece, and for that matter the 5-year-old Five-Star Movement in Italy, the older but until recently inconsequential National Front in France, and Spain's 1-year-old Podemos party. I know it seems like forever, given just how much press Alexis Tsipras and Yanis Varoufakis have rightfully received in recent weeks. However, they have been in power for less than a month, all the while spewing the most anti-bailout, anti-Germany, anti-Eurogroup vitriol imaginable, directly in sync with the platform they ran on and promised the desperate Greek public. Everything from the bailouts are dead to this is the end of austerity, the troika, and debt serfdom. Which is why, if Tsipras is truly giving in to the very same people he's lambasted for years, let alone all week, It would represent the biggest betrayal in political history, and likely would get him swept out of office as rapidly as he was swept in, as a pariah to be disrespected and reviled forever. Of course, it doesn't take rocket science to figure out what's going on here, as both sides are terrified of the horrific financial, economic, political, and likely social ramifications of a Grexit. Even Tsipras, who was for all intents and purposes elected to make it happen. For the Eurogroup, the historic loss it faced would be the least of its problems, as when Greece simultaneously defaults on its $300 billion of debt, it would catalyze catastrophic, cascading defaults across the entire European banking system, not to mention the individual central banks and the ECB itself. Worse yet, it would cause the other pigs, or as I deem them, the PFIGs when including France, to immediately demand the same, as the aforementioned Five-Star, National Front, and Podemos parties, to name a few, immediately rocket in popularity. The euro currency, of course, would be annihilated, and the subsequent plunge in pig sovereign bonds would cause Draghi to really do whatever it takes, by if not doubling, then perhaps tripling or quadrupling the current, yet to have commenced QE program, threatening dramatic, if not hyperinflation, for hundreds of millions of Europeans. As for Greece, it would indeed be out from under the blood-sucking debt yoke the Troika burdened it with, but it would be a global trade pariah with a new drachma currency in freefall and civil revolt due to the hyperinflation and bank runs its plunge would entail. Sure, Greece would inevitably rebound, but it would take years to occur. Years that Tsipras doesn't have politically to spare, I might add. And unlike when the same thing occurred in Iceland, the rest of the world, and particularly Europe, will be in economic freefall as well, yielding absolutely zero cushion to such a horrific financial blow. And thus, both parties agreed to kick the can for 4 more months, although, as noted above, not only is the deal not even yet signed, but the details couldn't be more ambiguous. Which means, of course, that essentially nothing incremental was actually agreed upon, other than to mutually delay the inevitable day of reckoning, in this case by a measly 4 months, to when Greece has several major crippling principal payments due. According to Germany, Greece is caving to their original austerity demands, and according to Alexis Tsipras, Greece won the debt extension without the accompanying austerity. So someone's lying, of course, which if the latter is indeed the case, which would mean Germany, the Eurogroup, allowed Greece to technically default on its debt. Don't worry, the bought and paid for ISDA, or International Swaps and Derivatives Association, which is chaired by executives of Goldman Sachs, JP Morgan, and other government crime partners, will never see it that way. But conversely, QE or not, terrified market participants eventually will. Either way, if such a deal is actually agreed upon this week, I'd bet dollars to donuts that the euro continues to weaken, as clearly the end game is upon Greece, whether PPT-supported markets give it 4 more months or otherwise. Oh well, I guess we'll just have to wait and see what Greece proposes Monday, how the Troika, the institutions, respond Tuesday, and if the sum total of this, quote, deal fraud enables the Eurogroup, the euro currency, and others to avoid all-out panic by Friday's ultimate deadline. Either way, this whole horrific saga, which is just beginning for Greece, the pigs, and countless other over-indebted nations, is going to dramatically escalate throughout 2015, at the latest by the new June deadline for Greece, if in fact the deal is concluded this week without imploding the precariously balanced, terminally ill global monetary system. To that end, with gold and silver prices this far below the mining industry's cost of survival, per what last week's hideous earnings reports clearly depicted, the odds of a disastrous financial, economic, and/or monetary event causing a run on the world's limited PM supply have never been higher. Heck, China alone has imported more gold than the entire world has produced in the year's first 6 weeks. Consequently, the protection of your hard-earned savings with real money has never been more imperative. And to that end, if you decide to take action by buying or storing precious metals, we hope you'll give Miles Franklin a call at 800-822-8080 and give us a chance to earn